Hi everyone, welcome back to our channel. Adi here. So nowadays everyone is doing either lump sum investing or your SIP, which is generally to do the this averaging, rupee cost averaging or dollar cost averaging. So today we are going to learn about enhanced dollar cost or rupee cost averaging. So how it's going to benefit you to get little bit more return from general what you are getting in your let's say SIP or your rupee cost averaging method of investing. So let's the video get started. So before we go to the enhanced version of rupee cost averaging, let's first understand what is rupee cost averaging and how it is currently benefits for you. Most of you must be aware of that thing, but let's just review that one. So what is rupee cost averaging first of all? So basically it is your SIP. You can see rupee cost averaging is an investment technique to investing your fixed amount of money to a particular let's say stocks or mutual fund on a regular schedule. So each month you are putting or in 5,000 or 2,000 to a particular fund and stock. So without a miss. Okay. So this is how you can say you are doing it currently in SIP. So what are the pros? So basically you don't need to monitor anything, because if you put an SIP in let's say in 15th, it will automatically invest in the stocks or your mutual fund. And also you can start with let's say mutual fund, you can start with 100 rupees or 10 rupees. So you don't need a huge capital to invest. And second, it's force you to save regularly, because you need to have that amount in your account. So you need to save that amount in your account so that SIP can be done successfully. And the last one is buy more share when the price is low and lesser share when the price is high. So let's say on that particular day, it's let's say the price is down for the mutual fund or share, then you will get more units of that mutual fund, or in case of US market you will get more units of that share. So but if you see there are some cons. So what are the cons? Let's understand that one. So okay, as it is an SIP, so each time you have to give a fees. So any transaction fees or any your tax and all those things. So as there is comparison to lump sum, because lump sum is a one-time investment, but this is a recurring investment. So you have to or get all the charge in your transaction. And second one is your, so basically lump sum will give you a higher return comparing to SIP, because lump sum you have to do your investment and give some more time to the market. But in SIP, as I mentioned, you don't need any time to monitoring. In long term, it will give you good return. So I'll show you in data how lump sum is getting. You'll get more return in lump sum. So this is basically is your two type of investment: rupee cost averaging with your SIP, and it is your second one is your lump sum. So both are there are cons and pros in both type of investment. So how will you get benefit of benefit from both the type? So if you invest in lump sum, you may get some pros and cons, and also same for SIP. So there comes your enhanced rupee cost averaging. So here what we will do, we'll combine both and take advantage of both the type of investing. So basically what will happen, your lump sum is here, your SIP or rupee cost averaging here. So we'll take few points and type of investing from both of these and combine it and make an enhanced rupee cost averaging method of investing. So we'll get the pros from let's say lump sum and your SIP. So we'll get bit higher return comparing to both of the methodology. So that is how and why you need enhanced rupee cost averaging. This is what happens in enhanced rupee cost averaging. So basically in enhanced rupee cost averaging, you have to invest more when the market is down, and you invest less when market goes up. Okay, so basically when the price goes down, you have to invest more. When the price goes up, you have to invest less. So this is how it works, and you will get more returns. So it is a combination of your lump sum and your SIP. So it's a regular interval you have to do the investing. So So you can see this is also means investor must be aware of micro environment and will have to spend time researching market, also time the market. So basically you have to give a little bit more time to the market so that you can track the any news or any research that's there, or daily your price and all those things. But for that I will suggest for mutual fund you can just check, let's say today's market down, you can just check, okay, the price has gone down, so you can put more amount to the mutual fund or the stocks. So this is how you have to do. Now I will show you one your chart, which is last few years of data from S&P 500 US market. So how your lump sum and your SIP, both way of investing, which one is better, which one outperform the other, so we can just check. So if you see here, so you can see most of the cases you can see the top one is when your dollar cost averaging. So basically your SIP outperforms lump sum. So it is very the times is very limited and low. You can see the DCA underperform lump sum. So here the if you invest in lump sum, so you will get more return. So this is the historical data you can see here. So as I mentioned, in lump sum you get generally you get more higher returns. So you can see also in data. So most of the time you can see in your DCA or your Rupee cost averaging, it's generally underperforms to lump sum, rarely in some cases. So that's why nowadays the enhanced dollar cost averaging or Rupee cost averaging is the popular idea. So let's go to the next question. Is it that simple or not? So I will say no, it's not that simple, but you can try it out. So it's if you are first time, you can try it out in some fund, and if you try it out and get to know, then it will be beneficial for you. For me, I tried it out around 4 to 5 months ago, so now I am getting the results. So this is the chart. Okay, so this is you have to understand. So when you will get more return on which aspect. So basically your aspect means, let's say your emotional. Okay, emotional means is my market is, let's say, going up. So in the bull run, so you can see if you invest in lump sum, you will get high returns, and in if you put like your enhanced Rupee cost averaging, you will get medium, and if you normally SIP, you will get your low return. It's comparing three different type of investing. And if you put some time to invest and research to the market, then you can see that in your enhanced Rupee cost averaging, you will get high returns compared to your lump sum, which will get a little bit lower compared to enhanced RCA. And SIP, as I mentioned, you will get a little bit lower to lump sum also. If you see the risk level, relative to each other, so risk level obviously in case of SIP or your RCA, it is always low. So enhanced RCA it's a bit high because it's a bit enhanced version of the RCA. And lump sum always the risk level is high, because if you invest, maybe tomorrow the market goes up, then that is good for you. If the market goes down, then it is also bad for you. So the risk level will be high in case of lump sum. So fees, as I mentioned, ERCA, RCA, because there are multiple transactions, so you have to pay more fees in case of ERCA or RCA. But if you see in case of lump sum, it is low fees. Now you are much aware that ERCA where it stands comparing to lump sum and RCA. So let's do one real type calculation. You will able to understand very simply how it is beneficial. So let's say you are doing your normal SIP, which is let's say consider Rupee cost averaging of a mutual fund. Okay. So let's say consider you are investing 5,000. So your annual investment is 60,000. Okay. So let me show the chart. So you put your SIP of first of every month. So this is from 1st January to 1st December. So you put 5,000, and depending on the price, you can see you are get these units allotted. So end of the year, so you have 603.21 units. If you do your normal SIP, you just put your money on the first day of buy the units on the first day of the month, and leave it. I mean, you don't do any research or anything, you just leave it. End of the year you will get 603.21 units. Okay, so similarly, let's say I'll invest similar 60,000 in 1 year, but I will do ERCA. So how will it going to benefit for me? So let's understand that. So similar 60,000 I am taking the annual investment. So okay, so you can see I am investing similar 60,000 and each month, but you can see the amount is not constant. It can be goes up, can goes down. So as I mentioned, when the market goes up you invest less, when the market goes down you invest more. So this is what happens. So let's say I first started on 1st January, that is 50, that's okay. So in the 1st February I didn't invest. In the 16th February I see, okay, the market is going down or going up. So I thought, okay, in this month I have to invest. So I just invest 103.1 and your 3,000. I didn't invest 5,000 because the market is going up. Similarly on March I also see the market is going up, so I invest 3,500, less than your 5,000, which is your normal monthly investment in SIP. So you can see in April and May the market was going down, so I invest 6,000, which is 1,000 more than my normal 5,000 investment. And similarly you can see all the pattern. When the market is going up I am investing less, when the market is going down I am investing more. So whole year I invest same 60,000 as your RCA or SIP, but this is on a different date and manually. So my unit at the end of the year will be 609.695. So in your normal SIP you get 603, here you are getting around 610. So let's consider 7 units you are getting more. So that means let's consider this year this mutual fund average price is 100, so you are getting 700. Okay, so what does it mean? So you are getting 1% extra if you do ERCA. So this is a small example of small amount, like say 60,000. So if you consider more amount, then your percentage of in return will be grow more. So you are getting your normal return in your SIP, but if you do this ERCA, it's more like enhanced SIP, then you are getting 1% or 2% top of that return. So that this will be good. So but you have to give a little bit time to the market. So if you want this 1 or 2% more return than whatever you are getting your normal SIP, then I suggest you give it a little bit more time. It's not that difficult. So you can start with any of the one of the mutual fund or any of the stocks. Then once you get to learn this with over time, then you can try it with all your mutual fund or stocks. So I hope this point of investing is will be more helpful to you. So this is a learning point for you. So if you like the video and this is helpful to you, so please hit the like button and subscribe to the channel. Thank you everyone.